Welcome everyone to the Wealth Management Review at Daniel Krug and Associates. Today's date is August 18th, 2022. Our presentation for today is titled Inflation and Where is it Headed? My name is Rocky Istvan and I'm the Chief Compliance Officer and Associate Wealth Manager at Daniel Krug and Associates. Daniel Krug, CEO and Senior Wealth Manager, will be joining me for this presentation. Just a reminder that this presentation is for informational and illustrative purposes only. It is not a solicitation and should not be considered investment or tax advice. If you have questions, just please give us a call in the office and we will help you out with those questions. Today's agenda, what we're going to cover. We're going to go over the current economic overview, where things are at in the economy. We're going to spend a little time on gas prices and inflation and how they relate. Then we're going to go into a little bit of where we think we're heading with inflation moving forward through the rest of this year and the next year. And we will summarize everything at the end.
All right, Rocky, I think we got a lot going on right now, and I really think that this is going to be a great one for everybody because it's going to go through a little bit of education on inflation. Rocky's going to kind of take a little bit of a deeper dive on that. I'm going to talk a little bit about gas and inflation and how it's correlated today to give everybody a little bit of a perspective on why we are where we are today. Yeah. So we can just dive right into it.
Why don't we do that?
All righty, let's go. Okay, so the economic indicators first. When you think about the economic indicators, again, we look at 20 major indicators, and the way these dials work again is you've got green is positive, yellow is neutral, red is negative, and then you have a dial on each one of them. The dark black is where we are today, and the gray is where we were the previous month. So when we're looking at these indicators, I'm going to focus, actually today, we're going to focus more on which ones have changed. So there's been several changes in here, and unfortunately, none of them went positive. So you've got the U.S. economic outlook, the yield curve, both of those have gone a little bit more negative. Housing and mortgages, they've gone a little bit negative. Housing market slowed down a bit. And obviously, mortgages have gotten a lot more expensive because interest rates have risen. You got the business outlook. Business outlook went from a high neutral to a mid neutral. There is a bit of pullback in business right now, which is not a good sign if you're trying to pull out of a recession. And then you've got the international outlook. Again, it went from more of a mid neutral now to a negative neutral. Because with the war going on in Ukraine and Russia, you've got a dampener going on here because it's lasting a lot longer than people had anticipated, and there is a bit of a worry that it's going to be spreading. So those are the big movers, and one of the things that I want to talk about is inflation. That's the one that was just kind of blocked out there in red. And how the gas prices are influencing inflation today. And I'll take a little bit of a deep dive on this. But before that, let's go back to January 2021. This is what the economics look like, the indicators from the market and financial industry. And it looked pretty good at that point. You really only had two reds, the political environment and geopolitical risk. You know, one of the things we talk about, Rocky, in investing and really any kind of major decisions, don't do it when you're angry or high on emotions, right?
Right.
And back then, even though the economy was going great, there were high emotions relative to the political environment. And unfortunately, people made some decisions relative to that. Now, there are some consequences to our decisions, and if we look forward, one of the things that happened after the inauguration of the current administration is Biden decided that, hey, we're going to reverse a lot of what Trump was doing. And one of the first things they did was relative to the gas and oil industry. So let's take a look at the gas prices from going back in time to today. So the gas trends, the price trends in 2021, you can see back in January 2021, the gas prices were down to $2.16 a gallon. That was January 4th. And you can see there was a steady rise in gas prices. And there was a myriad of regulations that went into play at that point that were actually pushing gas prices up. When you think about it, many of the news anchors are talking about the reason why gas prices are high. Some of them are saying, hey, it's Putin and it's war. Yeah, we're not really exporting that much from Putin to influence our gas prices that much. However, we are exporting more now than we have in years. Mm-hmm. But the other one is, the administration's talking about why are the oil companies gouging, and hey, you big bad oil companies, you need to get in line here and lower your prices. But here's the interesting thing. When you look at the chart that we have up there right now, this is from Fred, which is from the stlouisfeds.org website, and they chart a lot of statistics. And this chart really looks at the crude oil prices going back to 2008 all the way up to today. And back in 2008 during the recession, you can see we had really high oil prices at that point. And if many of you remember, the gas prices were right around $4 a gallon. Then the prices came down 2009 and steadily went back up from 2011 to end of 2015. At that point, what happened? Well, Trump came into office and he made some regulations that kind of made it a little bit easier for oil companies. And you had oil prices come down for a while. And there was something interesting, and I don't think this caught too much news, but in March of 2020, President Trump purchased a lot of oil at a discount to fill up our strategic petroleum reserves. Now, why is that important? Well, from a business standpoint, if you see something you're going to need in the future and it's at a very low discounted price, good time to buy it, stock up your shelves for the rainy day, right? So that's what he did. Now, as you can see in this chart, the oil prices started steadily going up from 2021, January 2021 and on, and they got pretty darn high from an oil price. But the question is the oil prices today, the cost per barrel, the only reason why prices are high? And I think we're going to find that might not be the case. Again, the prices that were for oil today is not that much different than it was going back from, we'll call it 2008 to 2015. But yet the prices in the past were lower than they are today. So let's go forward. Now, this chart shows the conventional gas price over the same time period. So you can see in 2008, when oil prices were really the highest, the gas prices were just hitting the $4 range. And then you look at the 2011 to 2015, which is close to where we are today. You can see at that point, the prices were under $4 a gallon, really somewhere between $3.25 and $3.79. But when you take that red line and move over all the way to the right, you can see prices today on gas kind of should be a little bit lower than where we are today, and I'm sure people are feeling the pinch at the gas pump. I don't know about you, Rocky. I filled up last week, and it was over $100 to fill up my tank. So pretty expensive out there right now. Actually, I filled up one time, and it was $120 to fill up my tank, and that was about a week and a half ago, before we saw the prices come down.
I've never paid that. Because I don't wait till I'm empty to fill up, because I don't want to have those big bills. But it costs the same. I guess that's the point.
Yes, it does. Yes, it does. So you can see that on the right-hand side that the prices have come down. Now, why did that happen? Well, it happened because the current administration, going back to the strategic oil reserves, have released over, what was it, 60 million barrels or 60 billion barrels?
A lot.
But a large portion. Matter of fact, everything that was purchased back when Trump bought it at a discount was released at this point. Now, some might ask, and I've actually had clients look at me and say, well, why would we do that? I mean, I understand I want lower gas prices, but why would we use up our reserves when we've got so much we could use of our own? Mm-hmm. And I liken it to a person who's got this great paying salary job, and they're working hard, they build up all this reserve money for a rainy day, and then one day they say, well, I've got a year's worth of income there, I'm just gonna stop working. And then they start using up all their reserves until they don't have anything left. Well, most people would say, that's probably not a smart thing to do. Mm-hmm. So, using reserves when you have the ability to bring the oil in, it's probably a questionable move. But it did bring down prices. Let's kind of move forward. So when you fast forward to the high price range, June 4th, we were at $4.84 a gallon. And if you were buying diesel, which many of you know that Jen and I had bought some property to build a ranch, and I'm buying diesel now for the first time, and I was paying $5.60, $5.90 a gallon for diesel, which is crazy. Now, because the oil reserves were liquidated to a degree, the price has come down to $4.19. Now, it's funny because we get conditioned, right? And we're like, oh, it's down to $4.19, let's fill up. But that's still way higher than it was January when it was in the low $2 range. Right. One of the things, when you're looking at those prices, let's talk about imports and exports of oil. So the U.S. imported 7.34 million barrels of crude oil a day last week. I mean, that's a lot of oil to be importing. And it was up by over 1.1 million barrels the previous week. So we're actually importing more, which means we're paying other people to produce our gas. And then conversely, we had our crude oil that we export reduced by $1 million a barrel. And there's some reasons why that is going on right now. There is a decrease of production in the U.S. oil market. When we talk about inflation, we've got a chart here that shows 2020, 2021, and 2022. And it shows you the monthly inflation rate that was existing during those time periods. And again, let's go back to January 2021, where inflation was at 1.4% for that month. And you can see the inflation was steadily increasing. That's kind of interesting as you're watching it, because you're saying, well, why suddenly did it go up like that when it wasn't going up before? Well, it comes back to administrative policy again. Let's take a look at the correlation between the average price of gas and inflation. And you can see when we overlay that same inflation, you can see that as gas prices were going up, so too was inflation. Why is that? People now, I mean, goodness gracious, you don't even go to the store, but you've got trucks delivering things to you all the time. Let's go through a little bit of a timeline here. So in January, again, prices were pretty low. The average gallon on January 18th was $2.37 a gallon. What's one of the first things that Biden did, and that was he canceled the Keystone XL pipeline. And if you know anything about the pipeline, it runs from Canada, goes east, and then back south through the US, and then back west to Texas. And the Keystone XL was going to literally go kitty corner from Canada down, and it was going to cut off a lot of mileage, I guess you would say, relative to getting the gas to Texas. And the additional thing was the pipeline was supposed to produce over 880 million barrels a day. That would have made us 100% energy independent, and it could have fed many other countries with much cheaper oil, and they wouldn't be reliant on Russia, Venezuela, OPEC as a whole. So it actually was good for the world, not just the US. February 26, Biden updates the social cost of greenhouse gas emissions, and this dramatically is altering the way the US government calculates the real world cost of climate change. Now, we'll come back to that because that's going to get into a cost for oil and gas that is going to create expenses for the industry. May 17th, now we're at $3.02 a gallon. August 11th, Biden calls on OPEC to producers to increase oil supplies to help curb rising oil prices. Well, the problem there is they just kind of thumbed their nose up at us and said, hey, you're creating this problem. Why do you want us to fix it? So they effectively have done nothing to support the administration. October 18th, 2021. Average gallon now $3.32, so you can see rising up. November 17, Biden sent a letter to the Federal Trade Commission Chair Lena Khan encouraging an investigation into oil and gas companies and retail gas prices. The move absolutely infuriated the oil executives. Why? Well, first of all, shutting down the Keystone reduced the production of oil by 25%. So could you imagine if you cut your income by 25%? How happy would you be? It didn't make the oil executives happy. And then they started going to someone else to try to produce the oil when they knew they could produce it through our industry. Again, didn't really make them happy. So they felt like there is now a war on the oil industry. So move forward. February 2021, now we're at $3.53 a gallon. March 14th, we're in the $4 range. On the 21st, Biden Security and Exchange Commission proposed landmark climate rules. You say the SEC, what does that have to do with oil and gas? Well, when you're trying to move people out of oil and gas, you're also trying to move away from what funds oil and gas. So basically, the administration said to the oil company, hey, we're going to cut off your money supply, or at least weaken it. Well, again, that didn't go over too well with the oil companies. October 29th, Biden and the Democrats propose a methane fee in the proposed budget bill. Well, this goes back to the emissions. This fee would start at $9 per ton in 2023 and increase to $1,500 a ton in 2025. Let's go back to business again. When your business costs go up, do you always eat the cost, or does it get passed on to the consumer? It's getting passed on to the consumer. So you're seeing a trend here of why gas prices are going up and why there's so much inflation. Now let's do the height. June 2022 on the 14th, the average price hit a high of $4.79 a gallon. you can really kind of see the trend. It's not Russia, it's not the war over there that's causing the gas prices to be high. It's literally a war on the oil industry. So it's something that, when you think about it, it's actually a fixable problem. And I've said this before, when it comes to really coming up with a good renewable energy, I think we need to do it. I think it's something that long term is very good for everybody. But it's the method, it's the way we're going about doing it that seems to be causing turmoil, not only for the oil company, but it's being passed on to us at the same time.
Right. And it's the timing of it. It's moving along pretty fast, so.
Well, you're right. It is moving very fast. If you think about it, this has been happening in basically a year and a half. These things have been going on, and there doesn't seem to be any end in sight. I think if I had any recommendations, I would recommend to the current administration to kind of put a moratorium on it. You know, let's get stabilized a little bit and then give incentives to these companies to really go after the renewable energy. And, you know, there's enough money in the oil industry to be able to do that if they're not being regulated and taxed to death at the same time.
Yep. So,
All right.
Good coverage on that. What I would like to do is shift gears a little bit and talk about inflation in general. So where is inflation headed as of this month? First thing I want to start with is inflation can be confusing. So CNR did a really good job of putting a couple slides together to help you get educated or reminded of some of the terms that you hear and what they mean and how they're used to make determinations on what's going on with inflation. The main thing is consumer price index. We've all heard that, but the issue is it can be reported in a variety of ways. There's different ways of measuring it in terms and periods of time that bring a lot of confusion into this. So I just kind of want to walk through this quickly. If you look at the left side of the chart, we've got a list of terms, what their meanings are, and then why it's important. So the first one is the market basket. That's the full basket of goods and services that is used to comprise the consumer price index. It's very important because this is what forms the basis for which the CPI is calculated. The second one is core CPI inflation. Now, what's the difference between core CPI and the full basket? It's basically the basket minus food and energy. So the reason they take those out is because those tend to be the most volatile on a month-by-month basis, and it helps you look at what's really becoming a larger or longer-term trend in inflation versus just being impacted by short-term supply shortages or demand increases, things like that. So consumer spending is 78% of the CPI, so it can be impacted pretty heavily by food and energy on a month-by-month basis. The next area is shelter. Now, when they're talking shelter, they're really not talking about everything. Shelter basically means your home, okay? It's the measurement of prices in the U.S. housing market. Shelter is the largest influencer on consumer price index. 32%, as I'm going to show you in a second here, of the CPI is made up of the cost for shelter. The next term is sticky prices. We haven't heard that in a long time because we haven't had inflation in a long time. But what they're trying to say is there's different types of price changes that can become longer term and harder to reverse over the long term. Those are what they call sticky prices. It's prices that are slow to respond to changes in inflation, but are also the most difficult to reverse. Then we have two different types of periods that we use to measure inflation in the consumer price index. The first is year over year. That's where we look at what has happened from a year ago to today. So it's an annual change, such as we're in August. So what was the inflation consumer price index in 2021 of August? And what is it in August of 2022? When you do it year by year, it tends to give you that longer perspective of how inflation is changing over time. And then the last one is the month by month comparison. That's where you're looking at this month versus last month. So it's really hard when you're hearing these numbers all being thrown around. It can get a little confusing, but basically those are the terms that we're dealing with on a regular basis. And now what I want to do is show you the composite, or how the CPI is broken down into four broad aggregates: food, energy, goods, and services. I thought this was a great chart because it shows you what percentage of these different areas of pricing that weighs into creating our total consumer price index. So food and energy are, like I said, the most volatile components and can obscure the impacts of these others because they're so volatile. What this next chart is showing is basically what we call core consumer price index, the core CPI. We take those more volatile month by month measurements out for food and energy, and then this helps you determine from a economic standpoint, are we seeing deeper problems in the economy than just short-term volatility, excuse me. So this is where we're getting more into the sticky types of price changes that tend to move slower, but also are much harder to reverse as we try to get inflation under control. So these are great charts to go and review. If you go back and look at this again on the replay after we put it out, to really understand what makes up the consumer price index and the core CPI. This next chart, we've heard a lot recently that, wow, inflation has dropped a little bit, maybe things have peaked. Well, there's been some early signs pointing that we may be at a peak. When you look at this chart, you can see where the red circle is, that we've had a few months here, very strong increases, but actually at the end of July, we've seen a little bit of a softening or a stabilization of inflation, which is good news. However, it's not enough data to really say that, hey, things are at a peak. We're going to have to watch this for a couple more months and see how the numbers come in. But yes, the July numbers are looking better than what we saw in May and June. Now, where do we think inflation is going from here? Well, we expect that the headline CPI inflation to the end of 2022 to end somewhere between 7 and 8%. If you think about that long term, Dan, that is very, very high. That's 3 times the normal, what we would call a stable inflation rate of about 2.5%.
Yeah, that's true.
And that's what the Fed target was. So very, very high throughout the rest of this year. However, we do see it falling about in half throughout next year in 2023. So the current signs of peaking are encouraging, but the Fed must stay on course to fight rising prices because there's still things out there that are driving inflation and keeping it at a high level.
Well, you know what, Rocky, it's kind of interesting, and maybe the clients are thinking the same thing. When it comes to year-over-year inflation, so we're going to be backing up against high inflation as it was coming up.
Right.
Are we going to be seeing inflation come down relative to that, or is inflation actually coming down?
That's a good question. When we're looking at the data, the projections, and they are just projections for next year, it is real inflation coming down. So we are expecting it to drop. We believe the move the Fed is making now is slowing the economy. And as we're pointing out in this chart here, the potential inflation impacts, basically the Fed has to stay on increasing the Fed funds rate so that they can hit that target of 3.25, 3.5 by next year. They're also at the same time unwinding their balance sheet. As you can see in this chart on the left, the Federal Reserve balance sheet is expected to go down. That's their purchase of assets they've done since COVID to try to stabilize the economy so that stock values and bond values remain strong and companies didn't go into default. Good move then, but they are still sitting on a lot of assets. As they unwind those and put those back out on the market, that increases the supply, which tends to lower demand because more becomes available. And so they need to do that so that they have some, what they call bullets in their gun for the future, that if things don't get under control, they can start rebuying and repurchasing and use that tool along with reducing future interest rates. But right now, everything's still fighting inflation and trying to slow the economy enough that it can stabilize. So as you can see here on the arrows, we expect long-term interest rates to continue to go up through this year. They're going to have to continue to move and keep moving pretty aggressively as they have so far this year in order to get inflation down and slow the economy. As a result of these moves, we expect growth to slow. It is going to slow down. We've already seen it, Dan, in the housing market. Finally, there's been some reprieve in what's going on in house prices, and the values and things like that are starting to stabilize. There's less and less mortgages, less and less new home starts moving forward. So we are starting to see the effects of a slower economy. We aren't seeing it on the unemployment side. Labor is still very, very high in demand. As the economy slows, we expect that to change and unemployment actually to go up. So this is kind of where we see things going over the next 6 months or so. But we're going to keep an eye on it as things move forward. So
wow.
I hope that education was good for people.
Well, I mean, it helps me, it helps everybody, I think, understand, get a better feel of what's going on and what's affecting things out there. It will be interesting to see what happens moving forward, because at the end of the day, you know what, we're kind of at the mercy of what the administration does to kind of bring this back in line again.
Right.
And you mentioned what the feds are doing, raising rates, which it certainly is slowing down the housing industry. There's no question about that. But at the same time, it kind of has an inflationary aspect when it comes to businesses having to borrow money, because again, bigger expense, pass the expense on to the consumer. So they've got a tightrope to run here to make this work. So we'll see what happens. Let's go on to the portfolio and some of the things that we're looking at doing or have done to make sure your portfolio stays in the best position. So actions taken. Number one, when you're looking at equities, the actions taken there is we're kind of underweight overall exposures when it comes to equities. It actually has been reduced in our portfolios. When you think about Asia and emerging markets, that's really going to a zero. We're not seeing a whole lot of growth there in the near term. We have also reduced exposure to Europe and to really more cyclical industries, not only from an overall portfolio standpoint, but a money manager standpoint. And then really when we're looking at the positions we have, looking at more focusing on quality, defensive, blue chip type stocks to weather through where we are today. From a fixed income standpoint, You know, here's an area that's just plain troublesome because I was looking at the reports, Rocky, today, and year to date, overall bonds, the aggregate bond fund is down over 14%. They're having some trouble right now, and it's going to be quite some time before they get out of it. And as we've talked about before, bonds as a whole are in a secular bear market, and that has bulls and bears. Unfortunately, we're in a secular bear market and a bear market. Yeah. So it's really challenging for them. So it's not like we're picking up a whole lot in the bond arena. However, there are some that are replacing some of the emerging markets. Keep in mind, almost all of our clients have life insurance, which is overfunded. It is a bond alternative. It gives you bond type increase in principal, as well as being tax-free if we take it outright. So it's a great alternative, doesn't have a downside, so the risk to that portfolio is very, very, very low. The other thing we've done is we've gone 10% to cash in the really high-risk portfolios, Profile 5 and Profile 6 portfolios. Keep in mind that when you're talking about risk profile 1 is very conservative, risk profile 6 is very aggressive. So our 5 and 6, we've gone 10% in cash. So we're going to be looking at that as we're moving forward because this volatility is not over. I've said it to many of our clients. I think we're going to have kind of a wild ride between now and the elections. One of the things we're looking at, if there is a red wave, we believe that the markets are going to look at that as a stabilizer because there's just been so much change over the last year and a half. They're ready for a reprieve. And if they do see it as a stabilizer, we see the markets moving forward from the elections. But it will be kind of volatile. If you think about where the market could go, and nobody has a crystal ball, but there is a likelihood that the market could, again, bounce down a little bit to maybe 3,500 on the S&P 500, maybe 3,900. So just be aware that there is still volatility in the market. We are watching it. Should we see that the signs are saying that we've got a much lower downturn, we will look at going more to cash in some of the portfolios. We are keeping an eye on it, and we'll keep you apprised of what's going on through the webinars, through emails, and obviously through our meetings with you. So that kind of brings us to a summary, Rock. You know, we talked a lot about gas prices and some of the indicators relative to why it's moving the way it is. It'll be interesting relative to the City National Rockdale charts on where they're seeing inflation. The question is do they see gas prices going down at the same time to really help this inflation issue here? Yeah. I'm kind of the mindset if the gas prices or oil prices, if they still put pressure on the oil companies, I think it's going to be tough to get that inflation down. But you know, CNR's got a great group of guys over there and gals that are researching this stuff. Yep. So we'll keep an eye on those.
And the big caveat is what's going to go on with Ukraine and Russia, and how long and how much it's impacting European oil supplies, yes, and needs and all that stuff. So they're going into a winter over there. So yeah, it's going to be interesting. That might keep oil and gas unstable going into the winter months. So
yeah, we'll see. It could. So there's a lot going on out there, and we want to keep you informed. That's why we're doing these webinars on a monthly basis. And you know, many of you came to our workshop in the training room last month where we did a full market recap. where actually I was out sick at that point, and Rocky and Danny did that one. They did an awesome job on it. But we're going to have more of those in the future. So you stay tuned with us and we'll keep you apprised of what's going on. Now, you know we have solutions when we have the market going kind of haywire. There's still other things that we have to be focusing on, and that is all around the wealth management of our firm and how we handle your overall estate. So you stay with us. We're going to keep you focused from a wealth management standpoint. You know, every time you say, tell me more, well, again, go to our YouTube channel at Daniel Krug and Associates YouTube channel, or you could go directly to our website, click on Watch Us, click on then DK&A YouTube, and it'll bring you directly to our YouTube site. So that's pretty much it. You take care of your family, and
we'll take care of you guys. Appreciate you being on board today. Look forward to seeing you soon.
Have a great day.
Goodbye, everybody.